Hello, I'm Paul Dowding, co-founder and head of design for Alpha Core and our Layer 1 DLT protocol, Tapestry X. Today, I'm going to be talking about the situation around FTX, some of the issues as I've seen them reported, what I think are the challenges for DeFi, crypto, and even traditional finance, and what are the solutions that can be considered to resolve some of these issues. The best way to look at FTX is from an accounting perspective and considering the balance sheet of both the exchange and its associated fund. The exchange should be relatively simple because it would just involve some equity, possibly some credit lines on liabilities, and then ultimately the infrastructure and technology that is as assets that support the exchange. And as predominantly a fee-based business model, there should be limited risk. The fund would consist of the equity from the investors matching to the investments that are made on behalf of the fund. If the fund engages in leverage, then there would be liabilities in terms of the money's owed, but obviously the assets would be, again, match the combination of equity and liability. The exchange should have been safe. So why wasn't it? Well, two main reasons. They didn't have any segregation of duties or controls around how the money within the exchange was used. And then ultimately, they misappropriated client funds to bail out of the exchange to bail out the fund. From the information that was reported today, as far as the fund is concerned, it took leverage, single directional bets, and predominantly in their own token, FTT, which, if you think about it, was a kind of self-fulfilling but unsustainable momentum play. They also, as reported, unethically front-run tokens that were going to be listed on FTX. And again, they had limited to no controls on how investor funds were spent or used. So, is the blame solely with the crypto and DeFi world? Well, actually, no. The traditional finance world has a role. Yes, DeFi does allow leverage single directional bets, where the credit and risk management is overseen by an algorithm rather than a credit or risk manager or a trading risk manager. The investments may have questionable value or utility, and because the smart contracts around the algorithms are published, they can be front-run and spoofed. Now, I don't condone these facts or practices. The exchange or fund operated in light to no regulatory environment, so really there was a responsibility for buyer to beware. Just in terms of these practices, let alone the possibility of outright fraud. Again, I completely abhor the fact that these practices are allowed in the crypto and DeFi worlds. However, it's often forgotten that despite being obvious use cases, the centralized crypto exchanges and even the crypto investment funds do not use blockchains as their ledgers. They may invest in crypto assets that exist in walled garden blockchain ledgers, but their own ledgers are based on the classic double entry accounting. And this is because the current blockchains cannot provide the performance, functionality, or ease of adoption to meet the requirements of the financial services at any scale. Also, it's often said that blockchains somehow remove the need for reconciliation. This is actually a myth. They're always going to be a sub-ledger and therefore have to be internally reconciled with trial balances and balance monitoring. And also they would have to be reconciled back to any ledger, general or otherwise, that they feed. Under published ledger reconciliation practices, blockchains don't have the equivalent of trial balances, and it's untenable to reconcile, to take their downstream ledger and reconcile back to them. Often people will say, oh, but we can run an algorithm against the blockchain and generate the right outputs. But in that case, the output from that algorithm is no longer part of that hash-linked record. And technically, to prove the accuracy of the algorithm, you should reconcile the output again back to the blockchain, which is an untenable process. So, if the exchange and the fund were actually using classic double entry accounting, why was there still a problem? Well, you can look at the history of events. FTX and its fund, took leveraged single directional position bets. That was actually the same as long-term capital management, which caused that fund to blow up. FTX had all the controls under the same group of people with no segregation of responsibilities or controls. That was what led to the downfall of Barings in the 90s. And then FTX misappropriated client funds. That's the same as what happened with MF Global and the credit default swaps. While double entry accounting allows for the recording of assets and liabilities and the measurement of risk and even for assessment for credit purposes, the problem is it's reconciled and audited weeks, months, or even quarters later after the events have happened. And then issues are only spotted if they have been recorded and audited correctly. There's a huge amount of latency in the process of accounting for assets in the current traditional financial world. So what is the solution? Well, the crypto DeFi world has shown us that a consistent protocol can allow peer-to-peer or business-to-business groups to be able to easily transact with each other, settling in hours, if not minutes. However, the customized smart contracts can be flawed or hacked. The solutions lack the controls and compliance, as well as the scale and capacity to handle legacy markets. And public blockchains, unfortunately, where you have no recourse, could not be used by any fiduciary in any regulated industry. The legacy world provides a scale and functionality for all markets, but it's slow and it's inefficient. The infrastructure is customized to each market and each product. The settlement is in days, and the processing is what they call optimistic, assuming it's right and hoping the reconciliations and accounting spot any errors or fraud. And there's a lot of expense and risk associated with exception processing. The solution then would be to take the best of both worlds. We need a consistent protocol. We need to be able to settle quickly, hopefully in real time. And then we need the benefits of the double entry accounting, but in real time. So if a protocol was agnostic to use case, in other words, flexible and applicable in many use cases, linearly scalable, with the capacity to meet the needs of the use cases, and allowing for real-time settlement, including the accounting, in the hashlink record. And then the idea of transacting periods, so future dated payable receivables, again, could be recorded in the distributed ledger, and that the distributed ledger could be interoperable with legacy infrastructure and other networks. So the solution would be to combine the innovation of blockchain technology and the speed, but with the scale and capacity and breadth of functionality and scope of and the accounting of the legacy world in financial services. So those things I just mentioned are all the critical requirements, which is what we considered when designing Tapestry X. We wanted to meet those needs. So if you'd like to discuss the challenges in crypto or DeFi, and also the legacy world, and the possible solutions, then please feel free to reach out to me. Thank you again for watching. As the Internet Protocol made communication consistent, Tapestry X will do the same for the secure recording and transfer of digital assets. Go to our website at tapestryx.com to book a demo. Thank you.